So let's take a look at the first transaction. The number 1 states owner invested $60,000 cash in the business. So from the perspective of the business, what happened was the business received cash from the owner, $60,000. So since cash belongs to asset account, as we learned, asset account is normal on debit side, meaning when the balance goes up, we put it on the debit side. So we'll put $6,000 here. And at the same time, what went up was owner's equity went up. So owner's capital account went up by $6,000. Since this owner's capital account belongs to equity account, and equity account is normal on credit side, meaning we put it on the credit side for it to go up. The balance will go up if we put it on the credit side. So that's the first transaction. Note that we always put whatever the account that will be debited on the first line. And the second line will be normally that will be credited. So I put cash first because I'll be debiting that account. And then owner's capital account was put secondly. And also you could see there's an indent. The cash was on the far left hand side, and the owner's capital account was written so that it will be slightly to the right hand side. That's a common way of accountants putting a journal entry. So we call this journal entry. When there's a transaction, we put the account that was impacted by that business transaction, and we put debit and credit. And also, please note, when we debit one account, we also must credit another account. These account could be compound account entry, meaning there could be one debit. Maybe we could be crediting in 2 different accounts. That's possible. But in either way, all the amounts that was put in the debit column must equal to the total amount that was put in credit column. So in this case, there was 6,000 on the debit, credit 6,000. So they balance out. So it must be balanced. Debit side total must equal to the credit side. So when you make a journal entry, you cannot put both accounts on debit side or both accounts the credit side. You cannot do that. If you are doing it that way, then something is not right. So make sure you put at least one item on the debit, another item, at least another item on the credit, and the total of both columns must equal. So let's go ahead and do the second transaction. The second transaction says purchased office furniture for $16,000 in cash. So right away, for me, I'm very I focus on cash often. So right away it says something about we purchased and we spend cash. So for me, I know that our company spend cash. So when the cash is spent and the balance goes down, it will be credited. Because cash is asset and it is normal on the debit side. But the balance did not go up this time. Instead, we spent it. So it will be credited. To notate that we spent the cash and cash balance went down. At the same time, what had happened? We purchased furniture. Furniture is a type of asset. So we will put furniture here. And furniture cost us $16,000. So if an asset that's worth $16,000 just was created in our company, so we should create an account called furniture and debit that account $16,000. Number 3, company bought a fax machine for $950. Okay, so right away we could see that fax machine, which is type of asset, has been created. Our company purchased fax machine. So since it's an asset, we'll debit that account, $950. And then it says payment is due in 30 days. So we did not spend cash this time. Rather, we promised the supplier or the person who sold that item that we will pay in 30 days. So let's call that accounts payable. Accounts payable is type of liability, and liability is normal on credit side. So by looking at it, we could right away see that, oh, we have now increased in liability. We call that accounts payable, and it has increased by $950. But at the same time, we have obtained fax machine, which is the type of asset. So we have debited that account. Number 4, we purchased a used car for the farm for $16,000 in cash. Okay, this is easy. This is very similar to number 3, except that it was paid in cash. So car is type of asset, increased by $16,000, and we paid cash instead of promising them we'll pay next time. So cash will go down by crediting it. Number 5, owner invested in an additional $10,000 cash in the business. Hey, this is too easy. Isn't it like exactly same as number 1? So here's let's do this. So what? Cash went up, right? Our company's cash went up by $10,000. And owner's capital also went up by $10,000. Once you get familiar with this debit and credit rule, it is so cool because, you know, even without reading this each transaction, you could just kind of look at this debit and credit journal entry and you could tell a story. For example, like you could by just looking at this, we could say, oh, you know, without reading the transaction statement, we could see that, oh, the company's cash balance went up and then owner must have brought the money because owner's capital went up, right? And then we also spent some cash to buy furniture, and we also bought car and also bought another fax machine, but this time we did not use cash for that one, but we increased liability by putting it on a term on credit. So it's kind of neat to understand these rules of debit and credit. Once you understand, you know, between the bookkeepers and accountants, this is like secret language that we could share